just at the T20, but also anticipating what's going to happen with the meetings. Please. Now I think it's the time for introducing the speech of Kristalina Georgieva, Managing Director of the International Monetary Fund.
Buongiorno a tutti voi. Thank you for the warm welcome, and many, many thanks to Bocconi University and the global think tank community for inviting me to this important G20 event. And I'm delighted to join Mario and Paolo for our discussion today. I am sure that the students at Bocconi University, like young people everywhere, are excited about their return to in-person learning and come to it with renewed sense of energy and optimism. And that brings me to the good news on the global economy. Over the past 10 months, vaccines have helped save millions of lives. And together with extraordinary policy support, this has allowed us to push forward, moving from crisis towards recovery. But that is only part of the story. We face a global recovery that remains hobbled by the pandemic and its impact. We are unable to walk forward properly. It is like walking with stones in our shoes. The most immediate obstacle is the great vaccination divide. Too many countries with too little access to vaccines, leaving too many people unprotected from COVID. At the same time, countries remain deeply divided in their ability to respond, in being able to support the recovery, and their ability to invest for the future. But we cannot secure a stronger recovery everywhere and shape a better post-pandemic world for all unless we work together to overcome these divides. And this will be the focus of our annual meetings next week. Let's look at the economic picture. In July, we projected global growth at 6% in 2021. As you will see in our updated World Economic Outlook next week, we now expect growth to moderate slightly this year. But the risks and obstacles to a balanced global recovery have become even more pronounced. The stones in our shoes have become more painful. I will focus on three of them. The first is the divergence in economic growth. The United States and China remain vital engines of growth, even as their momentum is now slowing. A few advanced and emerging economies are still gaining momentum, including Italy and Europe more broadly. By contrast, in many other countries, growth continues to worsen, hampered by low access to vaccines and constrained policy response, especially in some low-income nations. And this divergence in economic fortunes is becoming more persistent. Economic output in advanced economies is projected to return to pre-pandemic trends by 2022, by next year. But most emerging and developing countries will take many more years to recover. This delayed recovery will make it even more difficult to avoid long-term economic scarring, including from job losses, which hit young people, women, informal workers, especially hard. The second stone in our shoe is inflation. Headline inflation rates have increased rapidly in a number of countries, but again, with some more affected than others. While we do expect price pressures to subside in most countries in 2022, in some emerging and developing economies, price pressures are expected to persist. One particular concern with inflation is the rise in global food prices, up by more than 30% over the past year. Together with rises in energy prices, this is putting further pressure on poorer families. More generally, inflation prospects remain highly uncertain. A more sustained increase in inflation expectations could cause a rapid rise in interest rates and a sharp tightening of financial conditions. This would pose a particular challenge for emerging and developing economies with high debt levels. And that brings me to the third stone, debt. We estimate that global public debt has increased to almost 100% of GDP. Much of this reflects the necessary fiscal response to the crisis, as well as the heavy output and revenue losses due to the pandemic. And here we see yet another deep divide, with some countries more affected than others, especially in the developing world. Many started the pandemic with very little fiscal firepower. Now, they have even less room in their budgets and very limited ability to issue new debt at favorable terms. In short, they face tough times and are caught on the wrong side of the fiscal financing divide. So how do we go about removing these stones from our shoes and overcoming these divisions and obstacles to recovery? So here is our answer. Vaccinate, calibrate, accelerate. First, vaccinate the world. We can still reach the targets put forward by the IMF with the World Bank, WHO, and WTO to vaccinate at least 40% of people in every country by the end of this year, and at least 70% by the first half of 2022. But we need a bigger push. We must sharply increase delivery of doses to the developing world. Richer nations must deliver on their donation pledges immediately. And together, we must boost vaccine production and distribution capabilities, remove trade restrictions on medical materials. In addition to vaccines, we must also close a $20 billion gap in grant financing for testing, tracing, therapeutics. If we don't, large parts of the world will remain unvaccinated, and the human tragedy will continue. That would hold the recovery back. We would see global GDP losses rise to $5.3 trillion over the next 5 years. Let's go to the second piece of our answer. Calibrate policies to country circumstances. The longer the pandemic is with us, the more persistent the divisions between countries will be, and the more difficult and varied the policy choices become. Take inflation and monetary policy. Our view is that central banks can generally look through current inflation pressures and avoid tightening now. But countries that are already facing rising inflation expectations and more persistent price pressures have had to tighten, a difficult choice amid a stop-start recovery. And we must not forget to monitor financial risks, including stretched asset variations, which vary widely across countries. Calibrating policies also means carefully tailoring fiscal measures. The longer the pandemic persists, the tighter the fiscal constraints will become, forcing difficult trade-offs between lifelines to people, near-term support to the economy, and advancing long-term structural goals. Low-income countries face particular challenges with massive financing needs, high debt burden, and most recently, sharply higher debt servicing costs. They will need more revenue mobilization, more concessional financing, and more help to deal with the debt problems. To face these challenges, what works best is policy credibility. When governments project sound medium-term frameworks to ensure the right balance between providing support now and reducing debt over time, then there is trust from citizens and from markets. As countries grapple with the need to vaccinate their populations and calibrate policies, they must also look at the future, one that is greener, that is smarter, that is fairer. This brings me to the third policy imperative: accelerate the reforms needed to transform economies. Amid the sweeping global changes in the years and decades ahead, we see three priority issues for economic and financial stability: climate change, technological change, inclusion. We know that fighting climate change is critical for the planet and for prosperity. The dire warnings of the recent IPCC report on climate change leave us in no doubt that we must act, and we must act now. We need a robust price on carbon. We need substantial scaling up of green investment over the next 2 decades. And we need support for the most vulnerable within societies and among countries. This will help ensure a transition that benefits all, and one that is just. The green transition also presents huge opportunities: the shift to renewables, new electricity networks, energy efficiency, low carbon mobility. And to do this with a combination of supply policies, we can raise global GDP by about 2% this decade and create 30 million new jobs. And of course, private sector finance will be key, which requires stronger global efforts to improve data, disclosures, and taxonomies. The digital revolution also presents enormous opportunities. Scaling up digital infrastructure investment is key, combined with investment in people's education, in skills, in health, in basic research. This is how we can make economies more productive and more inclusive. To unlock this potential, we need fairer and more efficient tax systems. Completing the agreement on global minimum corporate tax is vital to help mobilize revenue for transformative investments. By working together, we can ensure that the transformation of the international monetary system benefits all. Just one example shows that digital currencies issued by central banks can reduce the time needed for cross-border payments to seconds and sharply cut costs. Clearly, the possibilities, but also the perils of new technology will need to be carefully managed. Given the enormity of the policy challenges to overcome these obstacles, we need decisive action at all levels, national and multilateral. For our part, we at the IMF remain a steadfast partner of our member countries. We are continuing to calibrate our financial support as well as our policy analysis and technical advice. And we will accelerate our own transformation to meet our members' evolving needs. We have stepped up in an unprecedented manner by providing 118 billion in new financing to 87 countries, and debt service relief to our poorest members. Thanks to the collective will of our membership, we provided a new allocation of special drawing rights of $650 billion in August. This is the largest issuance in the IMF's history in this crisis like no other. About $275 billion of the allocation went to emerging and developing countries where the needs are gravest. Countries have benefited immediately from holding the new SDRs as part of their official reserves, which can boost confidence and lower borrowing costs. And some already are using part of their SDRs for priority needs or planning to do so. Nepal for vaccine imports. North Macedonia for health spending and pandemic lifelines. Senegal to boost vaccine production capacity. And for Haiti, already facing a very difficult situation, the SDRs will help finance vital imports. Yet, there is more we can do to help countries remove the obstacles to recover. We can magnify the impact of the allocation, and we can ensure that more SDRs go to countries most in need. We are calling on countries with strong external positions to voluntarily channel their SDRs. This means getting SDRs into our poverty reduction and growth trust, increasing our ability to provide zero-interest loans to low-income countries. We are also engaging with our members on using SDRs to create a new resilience and sustainability trust to help low-income and vulnerable middle-income countries to achieve a sustainable and prosperous future. Making the most of these SDRs is good for the global recovery, good for countries, good for people. That brings me to my final thoughts. I often worry about the world my granddaughter, this little girl I so dearly love, will inherit. But our setting today gives me hope. It is a source of inspiration. Despite an ocean between us, we have come together to envisage a better future. The students gathered here, the fine students of Bocconi University, have the energy, have the enthusiasm, and the wisdom of learning needed to overcome the obstacles that lay before us. We have learned so much from the past 18 months. This extraordinary crisis has divided us, but it has also armed us with knowledge that allows us to think differently about our future. It is very fitting we are discussing this at Bocconi, where economic and social progress are values steeped deep in the history of the university. Now we should use this clarity of thought and the lessons from the crisis to remove the obstacles in our way, remove the stones from our shoes, and walk forward to a better future for all. Molte grazie.
Thank you so much, dear Kristalina. We are very, very proud to have your inspiring presence today at Bocconi with our friends from ISPI. And I believe that your message, well, to the whole world, but in particular to Bocconi students today, will remain as a beacon as they move towards a difficult but very promising future. You have a unique perspective on global governance. Very few people, maybe none, have the same perspective. You have held, with great honor, leadership positions at the European Union, at the World Bank, now at the IMF. So, can I ask you to reflect with us on whether you see any changes, any marginal changes maybe, to the structure of global governance and institutions needed in order to give more energy to the fight against pandemics and to prepare our health systems better in case of global health threats?
Thank you very much, Mario. My most sincere thanks to Bocconi University and to ISPI. And I'm so honored that Paolo is also with us, for bringing me to this remarkable T20 series of events. I am so impressed by your program. Anybody I would have liked to hear from, you have it on the program. So congratulations, bravo. Let me get to your question. What we are faced with is a very rapidly changing world that is more prosperous, but it is also at higher risk of more frequent and more severe shocks. We have seen it with the pandemic. This year, we have seen it quite profoundly with climate shocks. And that makes it so very important that we think about building resilience to these shocks by having a more integrated and collaborative system of governance in countries and, of course, at the global level. Let me start with an analogy of what has been done in terms of addressing the risks of climate change. For quite some time, that was a priority topic for environmental ministries, for climate activists, but it was not so much integrated, mainstream in economic policies. It wasn't top of mind for ministries of finance or for central bankers. That has changed, and we now see the impact of this change in terms of integration of climate policies. For example, at the IMF, our board recently approved bringing climate mitigation for large emitters, adaptation for countries at high risk into our Article 4 consultations. This is our annual assessment of where national economies are and where the global economy, as a result of this assessment, we can project to be. That is the right way to go. We also integrate climate in our financial sector assessment programs, the famous FSAPs. Why? Because we want to understand risks to financial stability stemming from climate shocks, but also from the transition to the low carbon economy. We have seen ministers of finance coming together in a coalition on this topic. We also have experienced a horrible health shock. The pandemic actually is not something that was not expected. For a long time, people were saying, in this highly integrated world, if there would be a transmissible disease that could go around the world, that could be a major risk, of course, to the well-being of people, but also to the world economy. And this risk materialized. What we now recognize is that, of course, our number one priority today is to fight the pandemic, so vaccinate, make sure we protect people, and we protect the world economy, the recovery of the world economy. But we also have to reflect, how can we be in a better position to anticipate pandemics in the future, to be better prepared for them, and to be globally mobilized. I saw you talking about the Global Health and Finance Board. This is going in the right direction, because what it says is we have to work across the health and finance community, actually integrate the health and finance community, so we can have measures in place to be much better prepared for the future. And of course, as always, when you are to go forward to create a new institution, if the global community decides to do that, which I think has a strong rationale, we have to reflect on what we have already, how we can make sure that there is no duplication, or we are not doing something that may not productively surface in the future, how we make sure that WHO, an organization that the world needs and needs it to be even stronger, can guarantee we have surveillance in place, and that fits into economic policy through this global board. To finish on this point, we are in a period of transformation, and rightly so. We cannot sit passive in this world of rapid change, and we have to accept that building resilience to shocks would require this institutional integration and collaboration in a way that is much more dynamic and agile for the future.
Thank you, Kristalina. I'm sure your words were very well received by the Italian presidency of the G20, which is working exactly in this direction of a global health and finance board, with all the caveats of how to fit that into the system that you rightly reminded us of.
Thank you, Mario. Managing Director, your words were also very well received by the think tank community. We have approximately 9,000 think tanks and experts connected to listen to the T20 and to your keynote. And let me thank you also on behalf of the entire think tank community, which ISPI and IAI are coordinating this year in the framework of the T20. You mentioned several potential threats to financial stability. Do you see digital and cryptocurrencies as one? And if so, what should be done to manage them?
Thank you, Paolo, for the question, and of course, thank you for being with you today. We, from the IMF perspective, are indeed concentrated on macroeconomic and financial stability. Whether we talk about climate shocks or pandemic or the digital developments, it is from that perspective how that would impact macroeconomic and financial stability. When we look at the world of digitalization, digital currencies, of course, are a very important part of it. Before the pandemic, remember, we used to say the future is digital. With the pandemic, the future has arrived, and very prominently in the world of money. So let me first talk about the opportunities that this presents. We are now in a position to fairly quickly accelerate transfers of money to make it seamless and less costly. But to do so, we need to be clear about what do we mean by digital money first. When we look at this universe, the most reliable are central bank digital currencies. Why? Because they have the backing of the state, and they are integrated in the monetary policy thinking of a state. Central bank digital currencies are still a novelty. In fact, there is only one in existence at this point. The Bahamas issued their cent dollar, the first country to have central bank digital currency, but they're going to be quite prominent. We did a survey of our membership, and it was very impressive. 110 countries are at some stage of looking into CBDCs, into central bank digital currencies. So that is going to be moving quite rapidly. And of course, that presents on its own a very important question: how do we guarantee interoperability of central bank digital currencies? How we make sure that we coordinate globally the impact that they may have on monetary policy. The second component of digital money are stable coins and e-money. They're privately issued, but they are convertible to national currency one-to-one. M-Pesa in Kenya or USD in the United States. They have backing in assets, they're liquid, and in that sense, they do fill the digital gap in privately issued money. And then comes the third category of money that is actually called money, but is de facto assets, like bitcoins. They are a privately issued, but not backed by assets, means of holding value. And this value is more volatile. It may go up, up, up. It may drop down. And in that sense, in the history of money, it is difficult to think of them as money. So my biggest point up to now is we have to differentiate and not amalgamate all these three into one if we are to understand the risks. When we think about the critical issues to consider, number one is trust. Is the public believing in digital, in CBDC, in stable coins? Is the private sector believing that this is a means of exchange that they can trust? And of course, legal frameworks are critical, institutional frameworks are critical for this trust. The second issue is domestic stability. Is this going to help to have more stable economic transactions? Can we have carefully designed public-private partnerships that provide for the economy rather than put it on more on rocks? And the last one is where the IMF and other institutions like BIS come, international stability. We have to have regulation. We have to get rules in place if we want, in the world of money, digital to be a plus rather than a risk. And it is very impressive how much the international community, the central banks, institutions like ours, are now actively engaged to make sure that in this fast-moving world of digitalization, money is a source of confidence and helps the economy function rather than a risk.
Thank you, Mario.
Now, if I may, a quick but maybe somewhat sensitive question, Kristalina. Under your leadership, the IMF cares and studies inequalities much more than before. And I salute this. I believe that all the organizations and national governments should. Now, there is a view, as you know, that a prolonged period of highly accommodating monetary policies pursued by the largest central banks in the world for some years now may contribute to inequalities in income and assets. What's your view on this?
Well, let me first be very, very clear that what has been done over the last 18 months by central banks helped prevent a potential collapse of the world economy. When the pandemic hit, central banks stepped forward very rapidly to make sure that when the economy is on standstill, we can retain support for households, support for businesses, and that has been crucial. What it also has done is to keep interest rates low, and in fact, what we see is debt going up, but debt service in many places has been going down. Now, that of course may change as we move forward in a world where inflation expectations may risk to de-anchor, and in that case, central banks will have to normalize policies. Now, when we have that loose monetary policy, obviously that makes it attractive to move into assets. And who goes into assets? People who have better means. If you are hand to mouth, it is unlikely that this would happen to you. But even for people that are hand to mouth, people who are the poorest parts of society, having credit at a low cost means that there is support for growth and support for jobs. So to sum it up, our analysis says the impact of monetary policy on inequality is muted. There are factors that make the wealthier benefit, but there are also factors that make poor people benefit from more accommodative monetary policy. This being said, we recognize we have to do more research in this area. And most importantly, we need to recognize we walk on two legs. We have monetary policy and we have fiscal policy. Fiscal policy can be very effective in addressing inequality and, if you wish, compensating to the extent that monetary policy may be more serving the richer part of society. And we have seen in many countries that recognition that fiscal and monetary policy do need to go hand in hand to protect the social fabric, to protect our societies for becoming more unequal. Unfortunately, this is, in this pandemic, a risk that we absolutely have to take to heart. And I hope we can work with you on this big question, how we can make sure that policies, monetary and fiscal policies, work for the health and vibrancy of our societies, work against inequality.
Thank you very much, Paolo.
Thank you. Managing Director, to avoid economic collapse during the pandemic, your recipe, not only yours, was spend, 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 and keep the receipt. We spent, someone kept the receipt, but the result you mentioned in your presentation is that debt has skyrocketed, and also in Europe. Do you see Europe more fit for the future to avoid a new sovereign debt crisis?
Yes, I do. What we see in Europe is a very clear recognition that two things need to happen. One, emphasis on growth. And the new generation EU is a fantastic example, not only in supporting the recovery, injecting a growth momentum, but doing it in a way that transforms economies to be greener, digital, more inclusive. And that emphasis on growth is also integrated, embedded in domestic policies. And secondly, a very strong attention on medium-term fiscal consolidation. We are already seeing countries recognizing that the bills are going to come due, and that it is important that we gradually project confidence in that stabilization. And fiscal consolidation need not mean that we are going to have brutal cuts in education and healthcare. It means that we project over the next couple of years how we are going to gradually shift course so the debt burden is to be eased over time. That combination of growth and medium-term fiscal consolidation, I'm confident will bring Europe on a sound footing, and ministers of finance in Europe, policymakers in Europe seem to be quite engaged on those two sides.
Thank you, Mario.
Well, now I have the pleasure of asking Ludovica Arconte, a Bocconi student, to stand up and ask her questions to the Managing Director of the IMF.
Thank you, President Monti, and good afternoon, Managing Director. I'm Ludovica Arconte, a Bocconi International Management student. And firstly, I would really like to thank you for your time and the inspiring speech. Focusing on the topic of climate change, an issue that we truly study in all its aspects, and especially how it impacts the economic, social, and political world of today, I would like to ask you some questions. Over the last year and a half, the pandemic has been the focus of our interest in all the sectors, attracting most of our attention and sometimes, we can also say, maybe distracting us from everything else. Thus, from a technical point of view, I wonder if the plans adopted to fight the pandemic at an international level, so both in terms of fiscal and monetary policies, have had or will have in the near future an impact on the actions planned to tackle climate change. Furthermore, I will add a second question from a more personal point of view, and I will take this possibility to ask you for an advice. And especially, what would you suggest and recommend to people my age, so students and young graduates, to do to have a really impact and a role in this global fight against climate change and its consequences? Thank you so much.
Thank you very much, Ludovica. Great questions. To your first question, when the pandemic hit, many, myself included, were worried that the climate crisis may fall off the cliff of our attention. That didn't happen. On the contrary, what we see is a stronger recognition that climate shocks like the pandemic can be hugely destructive and undermine our future. What is so critical is to recognize that the fight against climate change is also an opportunity for a tremendous transformation in the way we work, we live, we communicate, we move around, an opportunity not to be missed. At the IMF, we came up with a construct of what absolutely must be done. One, we have to create the incentive for shifting to low carbon. And as economists, what is the incentive? Price carbon. We must gradually go up globally with the price on carbon. We believe that from the $3 a ton it is today, it has to be $75 a ton by 2030. Some say even higher. Move in that direction so we insensitize low carbon production, low carbon lifestyle. Two, invest from the public sector in the ingredients that help this transition and generate massively employment as a result. And three, and the third piece is so critical, we must make sure that there is a fairness in that if you are a miner, coal miner, that society cares about you, that there is a transition path for you. In other words, that if we generate revenues from carbon, we have to spend some of this money to make sure that those affected by the transition are supported. And I very strongly believe that we are at a cusp of a massive opportunity becoming a reality as we unite. You know that COP26 is knocking on the door. Italy plays a very important role. And that takes me straight to your second question. What can you do? Speak up, engage, and think about the importance that this moment in history has for all of us. One thing that I am keen to see young people doing more of is to say, hey, we care about the world of tomorrow, but we also care about the people today, and be part of this just transition with your hearts, with your minds, with your skills. And I am listening to you. I think that you personally can do a lot of it. Be out there.
Thank you very much. Managing Director, I mentioned the 1,000 think tanks which are following you. 3 of them have a question for you. And let me start with Bambang Brojonegoro, which will be the co-chair of the incoming Indonesian T20.
Honorable Chair and distinguished panelists, first of all, I would like to extend my gratitude to ISPI and Bocconi University as the co-hosts of the T20 Italy presidency this year. In this opportunity, I would like to ask a question to Ms. Kristalina Georgieva as the Managing Director of the IMF. My question is, how and to what extent international cooperation or efforts can help find and channel the trillions of dollars needed by emerging economies to close their digital and green gap? Thank you very much.
Thank you, Bambang, and good luck. We have a second question, Kristalina.
Honorable Chair and distinguished.
We have a second question from Rose Ngugi, Executive Director of the Kenya Institute for Public Policy Research and Analysis.
My name is Rose Ngugi, Executive Director, KIPRA. I want to thank the Italian Institute for International Political Studies and Bocconi University for this opportunity, and Ms. Kristalina Georgieva, Managing Director, IMF, for agreeing to take my question. With COVID-19, significant efforts have been made to relieve debt burden for less developed countries, including through a debt service suspension initiative, zero interest rates on IMF lending facilities, and debt treatment under the common framework. My question is, how do we further strengthen the efforts for debt restructuring for less developed countries, particularly in Africa, and what remains to be done to better engage the private sector?
Thank you. And let's now move to the third question from Carlos Ivan Simonsen Leal, who is president of Getulio Vargas Foundation, since many years an historical partner of Bocconi University and also as a think tank also of ISPI. Carlos.
Good afternoon to all. I would like to thank ISPI and Bocconi University for the opportunity to put a question to Mrs. Georgieva here today. Mrs. Georgieva, my question is the following. The most important central banks in the world are preoccupied with a possible rise of inflation, and therefore they will react to it. It is possible that this action will trigger a very nefarious effect on emerging markets. And that may backfire to the rest of the world. I would please ask you to tell us what are your thoughts about that and how we may hope for some coordination among central banks so that the effects will be minimal. Thank you.
Great questions. We have limited time, so I would shoot straight to the first one. Thank you for asking about the international cooperation to mobilize the substantial financing needed for this transformation to green and digital future. What is required at international level is, one, fulfill commitments made. There is $100 billion a year commitment to help developing countries cope with the climate crisis. We ought to see that commitment fulfilled. Two, work with countries so they are more attractive for private capital. The countries themselves have a responsibility, rule of law, transparency, a good investment climate. But we as international community also have responsibility. International financial institutions collectively can be very supportive for that attractiveness. And we need to, third, part of the answer is we need to innovate. We have to come up with instruments that are removing obstacles for this massive mobilization of financial means in the developing world. Take, for example, first loss guarantee. If we were to imagine a world in which there is a standardized first loss guarantee facility that when the investor sees it in the country, knows exactly what it is, it may help us move. We also have seen huge mobilization of innovation in terms of green finance and massive increase in that area. The more we can do to standardize reporting and make it believable, trustworthy, the more we would see the financial flows going where they're most needed, and we will play our role in that. On the question of debt, we have seen a very important breakthrough with the G20 common framework that brings all lenders, including private sector, to provide support for debt resolution in highly indebted countries. We have 3 countries that ask for treatment: Chad, Ethiopia, Zambia. Very important that we succeed, that the creditors and the debtors are able to move forward, so more countries are to step into that. But beyond that, I would mark 3 requirements for success, especially for private sector participation. First, debt transparency. We cannot be in a situation when we only see the tip of the iceberg, we don't know what is underneath. And the IMF is very engaged to help with that transparency. Second, sound debt management. And again, we provide a lot of support to countries to do that. And third, advancing the regulatory environment so private sector participation is more effective. For example, for climate events, why not have a standardized clause that allows a country to have a breathing space as the shock hits? Moving in that direction on debt is hugely important, as we know that the debt burden is going up, and we at the IMF are concentrated on debt sustainability analysis and engaging with all players. So we do not allow debt build-up to turn into a crisis. And finally, I am extremely keen to see central banks continuing on the path they have adopted in this crisis: coordination. It has been impressive. It has to stay that way. Major central banks have a responsibility for clear forward communication of their intents. As for emerging markets and developing economies, now is the time to scrutinize your debt and see, can you do more in advance to what, as the question rightly pointed out, may be a forthcoming tightening of financial conditions. And again, we are here, we are doing our part, we are supporting our members to have prudent debt management approach in this time and minimize this risk. I know that we are to wrap it up. So back to you, Mario and Paolo.
Thank you. Thank you so much, Kristalina, for being with us today and for having shown us with great simplicity what leadership is, from analysis to policy clarity, to charisma and to inspiration. And we wish you all the best for your current and future work at the helm of the IMF. Thank you so much.
Thank you.
Thank you.
Siamo qua. No, no, Mario, sentiamo sì, questo faretti. Last minute agreement. We agreed with the President Monti that we will both...
I was trying to leave Bocconi University to Paolo, but he doesn't want to.
I would